All right, folks, welcome back. This is the daily log entry for February 23rd, 2021. All right, here's the 5-minute chart for euro dollar. All right, so we had a buy side liquidity pool over here, rallied up into that, broke lower, created a breaker here. We'll talk about that later in the video. Price trades lower ahead of Powell's speech. So there isn't a lot of buying and selling going on. It's just the market is just receding lower into New York. Small little bounce in here. Sell side liquidity pool, it attacks that. Notice this wick in here again. Notice that the bodies of this swing low is lower than this one. So while these are relative equal lows, it sets the stage for the market to potentially run back above this short-term high, this short-term high, trade back into the breaker, and if it got overzealous, we could trade back into this small little fair value gap there. The market rallied back above the sell side liquidity pool that was defined here, went once, twice, and then at the beginning of the London close at 10 a.m., Powell began speaking. The market trades up to this high, beats it by 1 pipette, comes back down, and then trades into this imbalance right here. Now we do have the redelivered rebalance effect in here, so we don't look at the candle that has that wick because it was overlapped with this candle, so it was redelivered. So we use the candle before it and the candle after the candle here. So that's our defined imbalance. Right below that would have been a institutional order flow entry drill. It comes almost completely back down into to close that in, but it trades back to this old low. So it bounces there, rallies above this buy side liquidity pool into the breaker. Didn't have the steam to get up into the fair value gap here. And the market rolls over and then consolidates going into the close of the day. Pound dollar, 5-minute chart. All right, so the market trades below sell side liquidity pool here, then creates a sell side liquidity pool ahead of London kill zone, runs back above these relative equal highs, dips back down into a fair value gap that's not annotated here because I want to keep it clean. I don't want to put too much lipstick on this one because it's a day where, with Powell speaking, like tomorrow will be at the same time at 10 a.m., the market is uncertain ahead of Fed Chairman speaking, and it's just something that you have to be prepared for and try not to expect a great deal of market symmetry, and anything can happen on those days. So the central bank will sometimes use what he says and what would otherwise be viewed as hawkish or dovish, that may be used in the delivery of price, or it may completely fade it, and what would be said by him or whoever the Fed chairman is, if it's considered bullish, many times the central banks will just go right in there and reprice against it bearishly and confuse everybody that likes to think they can predict fundamental responses. So I don't ever try to forecast his speech or whether he's going to be hawkish or dovish in response to the economy and what he thinks is going to happen. I don't care about that. I want to see the market's reaction. Ahead of Powell speaking, you can see that we have been consolidating. So there hasn't been a whole lot of expectation on the part of the British pound, but it did eventually create at the beginning of the London close, creates a institutional order flow entry drill, runs the buy side liquidity pool here. And again, just creating the high of the day in London close. So there's a small little institutional order flow entry here and a sell side liquidity pool run here. So they raid that and then run for the buy side liquidity. I want to talk a little bit about how to determine within intraday charts what side of the marketplace liquidity will be ran out on. Or in other words, what side is the market going to reach for when it's uncertain. There's no better day to practice this and study it than that of a Fed chairman speaking. FOMC is another day where you can practice, try to get a read on liquidity, but it's not meant for you to go in and say, I'm going to trade because this is high probability. It's not, but it's something that you need to study so that way you understand the impacts of these environments. And also, it'll teach you to respect them more than you probably do already, because most of you probably don't think about, okay, well, the Fed chairman's going to speak, so there's probably going to be a big move because of that. Sometimes, and then other times it just creates nothing. It doesn't do much at all. So if we consider what we have been looking for prior to Powell speaking today, we've been looking for lower prices on dollar and higher prices on foreign currency. So if we have a stage that's set where it creates a very clear and obvious resistance level, we have a high, slightly lower high, so this is relative equal highs. And if the market drops down ahead of the speaker and it's taking out stops, then this could be viewed as a false breakout, and they're accumulating the sell stops down here with their long entries, and they're going to want to offset above here. If we go back to euro, now if we look at euro dollar, you can see we had just drifted lower ahead of Powell speaking. So the same, I guess the same pattern I was referring to yesterday in our very long-winded discussion about how simple a model can be. Well, this same approach from here to here is that model that I referred to yesterday. So I used that framework here to set up a trade. And I actually traded with this institutional order flow entry drill, working with this redelivered rebalance. So that way you know it's not fluff. It's not just made up. I used it in a execution. And in a minute, I'll show you that recording and I'll walk you through it. But before I get into it, I want you to understand that these days like this, where it only creates a small little range of movement, do not be discouraged or think to yourself that this doesn't give me enough, because this is in fact enough. It's 20 pips, it's 10 pips, it's 15 pips, and you can literally make a career on that. Now, you don't think that it would be so easy to do so well with such a little threshold of pips. Harvesting that small amount of pips can in no way lead to financial freedom, but it does. It can, and it would if you give it a chance. You don't need these one hit 75 pips, 100 pips, 50 pips. You don't need that. If you get good at doing things like I'm showing you here and what we're building into, and how to practice, how to go into your charts and practice. If we're bullish on a currency and we have volatility expected, always side on the market that has the directional bias in mind. In other words, we were bullish. So if it creates a short-term high in here and like in here, and it runs ahead of a high-impact news event or speaker, and it's dropping down, many times that's just setting up a Judah swing. So you want to draw your attention back to short-term highs prior to that decline. Then you see this run up into the liquidity. Now, when I show you this video, I don't want those of you in here that can already trade, can find 30 pip trades and 50 pip trades or more. Don't look at this and try to discount this as you're trying to make something so little into something big. Because I'm going to teach you how you can do something like this alone, repetitively, and grow an account exponentially. You don't need a lot to do it. You just need to be consistently able to find something that repeats and then apply money management to it. So I used a very small amount of leverage. I used a very small amount of pips for a stop. And I didn't even get the best entry. I didn't even use the best exit strategy. I didn't take off all the position where I could have got 20 pips off. I didn't do that. I tried to work with what it would be like if you were going through the motions of learning how to do this. I could sit here every day and show you entries and exits and back and forth inside the same daily range, and that's only going to make you feel like, man, I'm never going to get this, because it's a lot. But if I can reduce it, and if you give me the permission, okay, and that's what I'm asking for here, give me the permission to show you the least with the least in terms of precision in the beginning. So that way it doesn't feel so hard to obtain for you while you're learning. Now, some of you are going to look at this and say, I still wouldn't have taken that. And that's fine. I understand that. But you will. You'll eventually get to the point where you'll be able to see it, you'll trust it, and you'll practice in it. But I'm not saying for you, especially for the folks that are brand new in month one, do not go into TradingView and try to do demo account trades or paper trading like I'm showing you an example of. You should be just observing. Okay, so when you watch the price move up in here and then come back down in, you think to yourself, and you write down on your piece of paper and say, okay, I think that it might go from here up to this high here and maybe into this breaker. So if it does that run, that's something I'm studying. That's my laboratory experiment for today, watching the euro dollar. I want to see, does it run for the liquidity that I'm aiming for? Now, back to what I said I was going to teach you today on my YouTube community tab. If we're bullish on foreign currency, we are still focusing on when there's high impact or medium impact drivers that are coming up on our calendar. We're going to be looking for areas for it to drive up into that. It doesn't make a difference, and it's not necessary for the market to go and create higher high than it does in the initial high of the day in London. We don't need that. In fact, you're going to see that my objective, best case exit for 25 pips, never gets hit, which is this fair value gap right there. But I'm teaching you, and I'm kind of building this up because I may not say it exactly when I'm supposed to say it in the recording because I got to overdub audio where I didn't talk during the video. I typed out things. So that way you can see what I was expecting. I'm typing it out in TradingView's application. So it's not like me saying, okay, I can talk about it after it's happened and voice over things that I didn't see at the time. You're going to see me doing the very things that I'm talking about, and I'm outlining it. So I show a split screen on the left-hand side that's going to be the dollar index over here, and then over here is the euro dollar. So that way you can see how I'm watching my charts. I'm not using TradingView when I trade. I'm using my own personal charts that would be associated with my broker. So when I'm watching my charts, I have multiple screens, and you can replicate that by having two screens on TradingView and having dollar index on the left. And if it's more comfortable for you to have the dollar index on the right, it's whatever. Me personally, I always tend to have the dollar index on the left and the trading market on the right hand side. So I'm always constantly referring back and forth to both. So if I'm anticipating a run higher here, I should be seeing a run lower in the dollar index. And there should be some objectives that I'm reaching for on the downside, as you'll clearly see in the outline before they hit. And that way it allows me to trust that the euro dollar is going to keep going higher. And at some point you'll see me say, okay, it's stalling in here and it's not good for me to be seeing it stall this late in the day. So you'll see me type that out in TradingView, and it's not like an overlaid annotation that I can add on my video production software. It's literally me opening the text box up, typing it out on the TradingView, and then moving the comment box once it's already applied to TradingView. Like you'll see it's that. And it's also a traded execution. It's not the replay feature. Okay, you'll see the candles going up and down. They're not completed as they create a new candle. When you use the replay function or feature on TradingView, it's a completed candle. That's it. Like you don't see it up and down until it finally closes. So I want everyone to have the proper mindset when they look at this, because if you can look at it as I'm outlining it and just think for a moment, if you just did 2 or 3 of these per week, applied sound money management to it, and allowed yourself to grow over time and pick up more of them, and you can pick up these types of trades once or twice a day. If you're a London trader and a New York session trader, you can find a setup in a currency twice a day, and it still wouldn't be all that busy. Now, if you're able to find 15 to 20 pips in London and 15 to 20 pips in New York, and you're able to do that 3 times a week, that, my friends, is very good. Very, very good. And what it'll do is it'll teach you that you can find them consistently, you can find them routinely, and while they aren't always going to be profitable, you'll get stopped out, sometimes you'll miss a move. It won't fill you if you're using a limit order. I just used a market order to get in here. I'm watching in the recording as you watch me enter the trade. I'm watching as it goes below this candle's low. So I'm watching as it trades into that. That is essentially the institutional order flow entry drill. That's what that is. And I'm trying to trade with the least imprecision. That's what I was trying to illustrate to you. I'm not trying to get consequent encroachment. I'm not trying to get the full closure. I'm showing you that if you know the range here that makes the imbalance, if you use institutional order flow and your stop is respectively placed outside of the imbalance and below this low here, that's what I used. My stop is there. It's a small stop loss. It's not a huge stop loss, and it's not a big potential price run. Best case scenario, okay, or best case scenario exit, I framed out on this fair value gap there. And I used this area here initially, and you'll see me put the little eyeball on TradingView. So you know where I'm focusing. While I may not be saying anything during the recording because I'm doing other things, I'm drawing your attention to in the recording. So that way it's, when it's down here, where am I aiming for? Here, and then here. And then once it gets here, then I tell you with the little eyeball that my focus is up here. It never gets there, but that's best case scenario exit. So just know that when I'm talking over this trade, I'm going to say things that you have already been exposed to. And I'm using it in this environment. I'm using it in this 5-minute chart, and I'm doing the very thing, just not waiting for the midpoint here like you see me do in my Twitter videos I used to post, where I used to do trades, executions back and forth intraday, and the ones that are still on my YouTube channel. Those are me really trying to be as tight as I can and show off. I'm not trying to do that in here because I want you to start at the lowest rung on the ladder of precision and be comfortable doing that. And I'm showing you, like, it takes a great deal of pantomiming for me to do what you see me do today. Like, I'm doing what I think it would be very reasonable for you as you're practicing, or what your expectations are. This is about what I would expect you to do if you were doing it yourself. And in the final portion, after I take half off of the remaining balance, the leverage I use is 125,000, and the equity at the time of the entry was at 10,270 something. I don't recall off the top of my head. I think it's 73 or 72. But I used leverage of 125,000, which may seem outrageous, but on a very small stop loss, it's not a lot at all. Like, it's really small. But if I could have gotten a run to 25 pips, that would have only happened on 50,000 leverage, or $5 per pip. Whereas I took off $2.50 per pip. That portion came off when we went above here. So when that happened, I was trading here, and I waited a little bit more, and then I said, okay, it's stalling. If it stalls like this, I want to take off half of the remaining balance, which was 100,000 still on trade. Then I took 50,000 off, which is $5 per pip. So that came off, and then I moved the stop loss up, and I just let it get stopped out. Now, if it would have ran up, and that would have been great, fine. But I put it in a position where it's likely to get stopped out, but if it doesn't, so what? It shows you the things that you're learning throughout the early stages of this mentorship, what you're looking for. What does a trade look like? And if you can look down here, it kind of looks sloppy. Like, to the untrained eye, like, that doesn't look like anything that would really jump out. Doesn't look like something you would have expected to trade unless you've been training under me. But I've taught you just recently the redelivered rebalance, and you understand what institutional order flow is, and you understand what a fair value gap is, and that's all three things in this little element of price action right there. And the idea was, I'm reading liquidity. What side am I focusing on? There. At some point in the early parts of the video, the recorded trade, you'll see me take note that there is engineered liquidity here and engineered liquidity up here. with this high and this high when it's trading down. So I'm telling you, notice that there's clean highs here and clean lows there. Which side is it going to go for? Well, that's the lesson's topic tonight. It's going to go for the buy side liquidity, because the buy side liquidity is in the direction of the underlying bias. We're underlyingly bullish on euro still. Nothing has changed. This is just a retracement. So if I ever have this condition where it's relative equal lows and relative equal highs, which side of the marketplace I'm going to aim for? I'm going to side with the higher time frame. It does not mean I'm going to be right. It doesn't mean it's going to be 100% accurate every single time. This means that that's the side I'm going to look for if I have the narrative in play. And you'll also notice that when it goes up here and trades back down, I'm not afraid to see that still as a buy. So I'm able to see this price run here, up into here, and potentially up into there. I did not call for a higher high. Notice this in the video. I'm only looking for best case scenario, but this is where I'm looking for here, and that's the bulk of where the trade comes off. And then it stops me out at, I think it was just under 10 pips for the balance. So it's not a lot of pips, but it is something that is clearly seen in hindsight that, like, if you would say, if I could find these types of runs here a couple times a week and you could do it consistently, that adds up a lot. But you, as a trader, don't see people doing that online. When they make videos on YouTube or they make courses, they're always selling you on this idea of 100 to 1 R multiple trades, 25 to 1 R multiple trades. You don't need that. You really don't need that. You absolutely don't need it. If you know what you're looking for, you can do 1-to-1 trades as a scalp, as long as your risk is small and managed. You can completely carve out a routine that makes that your career. If you think about how it was for me when I first started as a trader, when I was trading the S&P market and the bond market. In today's world, where we watch the S&P Standard & Poor's, it can move 50, 80, 100 handles. That's like 100 points per day. Back when I was trading, if we had 4 handles a day in movement, that was a lot. Now, think about that. Like, that was a pretty sizable move. If you had 4 handles, 400 pip or 400 point move intraday, that was considered a very sizable move. Now, what I'm talking about here is if you can find cookie cutter approaches to find 10 pips, 15 pips, 20 pips intraday, that is more than I was used to as a day trader back in the 90s trading the S&P 500 market. So for you, it sounds silly. Like, I've watched ICT call 1,000 pip moves, 500 pip moves, 200 pip moves, 100 pip moves per week, 50 pips every other day. Yeah, you see that. But it's not realistic for you to think that it's just going to be a waltz into, here I am, I'm in the trading now, and I watched a couple of ICT videos and I'm going to be able to do that. No, you're not. But if you get very comfortable with finding the smallest fluctuations in price, and you can see it on these intraday charts, it's the same thing applied to higher time frame charts, but brings larger harvests in pips. It won't be 10, 15, 20 pips. It'll be 30, 40, 60 pips, and then go up to a higher time frame, 4 hour. It could be as many as 100 pips or more, and then daily, a couple hundred pips. So it's all relative, but you get so much opportunity to practice reading price and running for liquidity in these lower time frame charts. So that's why we're doing this lesson tonight, because I had a lot of folks come in this recent group and they are not interested in doing all this intraday. Like, why am I looking at a 5-minute chart? Like, I have no interest. I'm never going to trade a 5-minute chart, Michael. Even if you don't study what I'm showing you here, and just for the sake of imagination, forget that number 5 exists and say that's a letter D for daily. This is the same thing that a daily chart can do. It just means that the candles are going to have more pips in them. It doesn't sound logical for the first time when you hear it, but when you take a step back and you look at how price action moves, and study it. It's the same thing happening on these bigger time frames where there's big pips. It just takes longer for those opportunities to pan out. You would not be so interested in listening to me talk about a move that's framed on a daily chart where it takes months for it to pan out. Like, you'd fall asleep. I mean, I'm already putting people to sleep with my long videos as it is. But in this gives you the framework so you can go in and study each day what is available. And after a period of time of studying it and observing, then you paper trade them. Not paper trade with the demo account type thing for TradingView. When I say paper trade, you literally look at where it's at and say, okay, you look at that area where you would, I guess the easiest way of saying it is that you're pretending, without even doing a demo account, you're pretending that you're buying here, and you put that hypothetical price in there where your hypothetical stop loss would be and where your target would be. And we'll just say 5 pips above this old high. And that would be it. So if it trades there, you would record in your paper trading journal, say, I took a trade at this time. You write down the time that you would have been filled on the candle, what time it gets to your target, and where your stop loss is, and then record how much heat or how much drawdown your trade absorbs before it moves into profitability. And if you do pretend to take partials, where they would and how much it would be. And then you total up how much that is, and you say, okay, if I had a hypothetical $10,000 account, or a hypothetical $25,000 account, or a hypothetical $1,000 account, whatever it is, you determine what your rate of return would be. And then you take the next trade, the next laboratory experiment, okay? Now, you don't need to do this live like you watch me do in a couple minutes, but it's better if you can. If you can do it, then do it. That's why I said if you can have a recording software program, like I use Camtasia. I've used it ever since I've been making videos with the market. I get the upgrades every now and then. I haven't got the most recent one, but it's a fairly easy platform to use. But if you have a means of recording intraday data, like on a 1 minute and a 5 minute chart, and just let the recording go all day while you're at work or whatever, your screensaver might come on and protect your monitor, but it's still recording behind the scene. And then when you come home, compress it into whatever speed you want to watch it. And then you can literally study watching what price does. And there's no better way of doing it, because the replay function on TradingView, while it's okay, it's still not the same as watching the candle form and watching it look like becomes a bullish candle, then it erodes to a bearish candle, and then it comes back up to what looks like it's a bullish candle, and then it closes on a closing basis that's bearish. Like, you need to see that. That's experience that you can't get from a static chart like this. Now, I can teach you conceptually majority of what you're going to learn. It will be this way. But at some point, you're going to want to see me doing these things, and that's what I'm trying to ring in this year. I'm trying to show you what it looks like and how you watched me do those short little clips on my Twitter and on my YouTube channel, where I'm going in there and doing surgical strikes here and there, back and forth. This is the beginning stages of some of that. You're not going to learn all that because that's Enigma, but this is one form of doing it, where if you go in and you find these little setups each day, if you can get 10 pips once a day, and you think about it, if you can get 5 of them over the course of 8 different trading sessions, assuming you don't do any trading on Monday, okay, so you'd have London and New York on Tuesday, Wednesday, Thursday, and Friday. That's 4 times 2, that's 8. So if you had 10 pips surgically taken from each session, each one of those days. Now, I'm not saying you're going to, but let's say it's your goal. Well, that's 80 pips. That is awesome. Like, there's no reason why you should worry about trying to make these big pip hauls. Don't buy into that Instagram stuff, okay? These people are phony, they're fake, and you could literally win the Robbins World Cup doing what I'm going to show you today. If you just did this a couple times a week, you will beat the people that participate in the World Cup. There's a gentleman that I just watched it before I started doing the recording. I believe his name is Raul. I watched him go from like 60% to 90 some. He dropped down a little bit. Robert Miner took first, and he stayed at 90 something percent. He hasn't moved. And then all of a sudden today, Raul blasted past him. He's up at 147%. He's taking big bets. Okay. Just watch him on the leaderboard. and watch what happens, because he's already taken big hits, and then he lost his leadership to Robert Miner doing something over leveraging. But his over leveraging just now put him in a nice lead. If he's smart, he'll sit there for a little bit, but he probably won't. If you trade like I'm going to show you and I'll keep saying in a couple minutes, but I really want the right mindset before you watch me do this, because it's very easy for someone to come in here that thinks high and mighty of themselves, or like to be highly critical and say, he's making a big deal of this. No, because I could do this every single day in every session. That's the thing you need to understand. You can learn how to do this in every session, every single day. You don't need the full daily range. What happens if you sold short here and took 10 pips out of that? Is that not profitable? Sure it is. What if you sold here and got down here and got 10 pips out? Is that profitable? Yes. What's wrong with that? Nothing. That's the kind of stuff I was looking for as an S&P trader. But it wouldn't be, but sometimes like a handle and a half or 150 points. Now, that wouldn't mean a whole lot in money, but for the range, it was a good portion of the range. Now, if you look at the high of the day here to the low, that isn't that much. You have basically 10, 20, 30, 45 pips. So the daily range is about 45 pips. So if you're taking 25% of the daily range out, that's good. There's nothing wrong with that. And in fact, that's amazing, really. When you really take a look at it on a data standpoint, like, you don't need the full daily range. You don't need to sell at the absolute high and hold it to the absolute low. You just got to look in here where the meat is, because the bone is going to be what it is. If it's going to be a 45 pip day, then it's going to be a 45 pip day. You don't necessarily know if it's going to be a 45 pip day. There's no way of knowing with absolute assurity that that's going to be a 45 pip day. But if you know how to find these setups and runs on liquidity, it doesn't matter how big the range is going to be. You just know where the stops are and where that liquidity is going to draw on price. And if you find the imbalance, okay, what side is it going to reach for? The long side. Where's the highs? Here. So if I'm buying down here and I'm only going to go to here, is that worth taking a trade? No. Can I buy down here and get out above this high? Is that worth taking a trade? Sure. It's about 10 pips. What happens if I buy here and I can get out up here in this small little area with a fair value gap and a bearish order block? Sure, that's reasonable, especially because it's a breaker. But if it gets overzealous and really, really runs more than I expected, I have something in place to get 25 pips and I'll be done. And I don't need it to trade above the outside of this high. In other words, it doesn't need to make a higher high. I'm trading inside this range. Okay, this is what I'm showing you. I'm trading in the range. You don't need it to break out, because I'm not a breakout artist. I'm using liquidity. Okay, so with that, just know that after I did this drop down here, you'll watch me get stopped out on the remaining balance, and it's fine. I made over 1% doing it. Now, 1% isn't earth-shattering. But if you make 1% daily on the smallest little bit of effort, and it's a small little minute amount of risk, do the math on that. It adds up real quick. And you don't need a lot of money to see it add up real quick. And that's why I said on my community tab, I said, imagine if you did 1% per day. Now, it doesn't mean every day, but every day that you trade, if you got at least that, 5 years from now, where would you be? Doing the least. Amazingly, okay, you would do amazing. But as you grow in your understanding, you're going to learn to do more than I'm going to show you here. You're going to learn more than that. But if this is all you do initially for the first 6 months while you're learning more, you're doing way better than retail. Because they don't know what they're looking for. They have no idea what they're trying to frame a setup on. They have no idea what the pattern is. They're just chasing. They might have a stochastics, moving average, crossover, whatever. But if you really looked at what they were doing, you would see that they're chasing price. It's going to start moving before they buy it or before they sell it. It's moving. And that is their confirmation. I don't like that. You'll watch. I'm entering as it's going down. When the candle's going down, that's when I'm buying. That's what you see me in every one of my trades. I have to be seeing a candle moving opposed to the direction I think the market's going to go for my profit. So if I'm aiming here and I'm aiming up in here and it's going down, that's how institutional minded traders enter. They have to go in the market as it's going down. That's the only way to be made assured of a better fill that's efficient, because you can get positive slippage, but generally the broker won't offer that to you. But it's a terrible thing to be buying when the market's starting to go up, because you can get slippage, which is if you're trying to buy it, for instance, say if you're trying to buy it at 21.45 and it's going up, you might get a fill at 21.50, depending upon how slow your broker's reaction is. And it might be a huge exaggeration on my part there, but back in 2006, when I moved away from futures and only traded Forex, GFT Forex, who also closed an account on me because I told him I was trading with my son, letting him use the account because I wanted him to feel what it feels when you have, it wasn't his money, it's my money, but he was losing money. And I told the broker, I said, look, my son uses that account, and I don't even know why that even came up in the conversation. He's like, what? Your son's using that account? We're only supposed to let the holder of the account trade, so that's against the rules. And I was like, oh, it's no big deal. It's not that much money. And he answered my question, and when we closed the conversation, the account was closed, and they sent me a check for the balance. They wouldn't let me trade with that account anymore because it's against the rules. So I don't even know why I brought that up. I don't even know why I brought that up. But about the slippage. The GFT used to slip me a lot. Like if I would go in and buy it at the market, I would have like a pip and a half slippage minimum all the time, and they would do it all the time. So if you use the market trading against the direction, it reduces that effect. Whereas if I'm trying to buy as it's going down and it still fills me a pip and a half above where I see it printing at the time of me entering the execution, how much would it be if I was trying to buy it if the candle was going up? Probably as many as 3 pips slippage. And in a real fast market, who knows where you're getting filled at, So those are things that you have to be observant and concerned about. And that's why I teach you the way I teach you. It doesn't feel right buying when the candle's going down. It feels scary. It feels like this doesn't make any sense. But you're going to see me doing it right in here. As it's going down, I'm buying it. And I'm using the logic of the institutional order flow entry drill. And while it does go down a little bit against me, that's fine. It's not a big deal. It ain't hurting me. I'm expecting as much as this, movement. And if it did that, then that's fine. But it goes just almost to the close of that imbalance, but doesn't go to my stop. I don't open my stop up either. And I'm not in a hurry to rush my stop up. Notice that also in the recording. There is a time when I do move the stop up, but I tell you reason why I move it up. And in reality, in looking at it in hindsight, with the benefit of hindsight, talking to you, I did the right thing because it ultimately went down lower than my entry. So if I would have kept my stop at the original entry, while it wouldn't have necessarily been stopped out here, it's just not something you want to see, having all that open profit erode when you can manage it. And if you get stopped out and it goes higher, who cares? If you do the right things in managing your stop loss, it's going to prevent you from having drawdown as large as it would have been if you didn't do these things. And also, you're going to see by trading the way I teach you, you're going to have winners more frequently than losers. And that's something that most educators can't claim, but I am claiming that. If you do what I tell you to do and practice the way I tell you to practice, you will see it. It's evidenced in what you'll observe in your own laboratory experiments, like I'm teaching you here today, and in the results. So with that, let's go over to the recording, and then we'll make this video complete for today. All right, so I'm looking at the dollar index on the left-hand side, and you can see me drawing attention to that buy-side imbalance, sell-side inefficiency. I'm telling you, I believe it's going to go down there as a result of Powell speaking, and I believe it's going to go to that buy-side liquidity pool on the right in Eurodollar. So I'm framing out the liquidity pools, but I've already outlined in the recording prior to you watching this portion that I'm bearish dollar, bullish euro. annotating the buy side liquidity pool being taken, or buy stops being taken on dollar. And I'm looking to see if it makes an attempt to go below those relative equal lows and then still run those buy side liquidity pool on the euro. Okay, you notice it's essentially about 7 minutes after 10 at the time of the recording. Notice it is not the replay feature. The candles are forming dynamically. They're not static new candles. All right, the dollar starts to break down, and I'm going to look at the bottom of that fair value gap on the dollar. It's trading at 90.16 and 3 pip bets. I say that it's likely to retrade back up into that. Watch and see if it does. If it does, it could potentially sell off into that area I'm putting the eyeball at now. That's what I'm anticipating, or having the likelihood of. If it does, then it's great. But right now you can see it's too heavy. Euro dollar's going up. At this point, I'm thinking I may have missed the move. But if it can give me that return back into that redelivered rebalance on euro, I will go long there. That's what I'm thinking. So at this point, I'm thinking, well, I'm probably showing enough that you can see there was some prognostication where the fair value gap was a draw on liquidity for dollar. But now look over here. You have a buy side liquidity pool being engineered and sell side liquidity pool being engineered with relative equal highs and relative equal lows. Which side am I going to side with? The liquidity on the buy side for euro. Consequent encroachment, I outline in text in the platform. It's going to offer resistance, and watch that dollar index do that very thing. I'm framing out the redelivered rebalance on euro on the right hand side. I have my order set up, 10 pip stop loss, and I'm long. Now we're going to sit here and watch. You can see that the euro dollar does go down a little bit, gives me a little bit of heat. It's not much at all. Every pip, one full pip, is $12.50, so it's not even a lot. All right, and study that consequent encroachment on that dollar index. Look how handsome that is. That's right out of what I've been teaching you. All right, so the dollar should start to fall out of bed in here, and euro dollar should start to increase and trade up into those relative equal highs. Notice on the euro dollar chart, I have that little eyeball. That's where I'm focusing. So while the chart is going up and down on euro, my eye is watching, are we still progressively working towards that little area where the eyeball is on the euro dollar chart? And I'm measuring the continuity between the decline on the dollar on the left hand side and the advancement higher on euro. So I'm constantly going back and forth with my observations. I'm not just staring at a euro dollar chart. So part of this mentorship is for you to understand how I manage my charts, and I don't have the kill zones on there. I just know that these setups form in these time windows. But for you learning, you have to have them on your chart, so it teaches it to you. Dollar index is about to plow into that buy side and balance, sell side inefficiency, as we see here. And euro dollar explodes above the buy side liquidity pool. And I'm going to take a partial off in here. I'm going to slow the video down to normal speed right here. You can see I'm taking off 25,000, which is essentially $2.50 per pip. And you can see the orders executing. Okay, so now I have a balance of the equivalent of a one standard lot on euro, and I'm adjusting the stop now because we're late in the day. It is 10:30, and I taught you yesterday that I'm usually out of the market between 10 and 10:45. So according to that rule I have, I'm trying to tighten up the stop loss. I don't want to see any of this become a losing transaction. So now we've traded to my initial objective. So now I'm focusing here with the best case scenario, which was where I placed my limit to exit in the beginning. So all of my trades always have a best case scenario. So that way, if it moves way beyond what I thought it was going to trade to, then I have something in there to take me out at that level. Doesn't mean it's going to go there or that I have a high probability of getting there. It just means that it's just icing on the cake if I catch something and it's a tiger by the tail. And I talked too much. I didn't mention, but you can see it. I outlined the volume imbalance that the dollar index trades down into. It goes a little bit deeper into that still. But overall, this alone, if you could do these types of setups once per day, this is all you need to carve out a career, to replace your job, to pay your mortgage, to put food in your refrigerator, to pay your utility bill, okay? If you do this and you practice like this, and you can find these setups that occur every single day, every single day, your confidence will grow exponentially. You won't fear losing your job. You won't worry about the economy. You won't care who's in office, who your leadership is. You will be able to feed yourself. Okay? That's what I'm trying to teach you here. But I don't sell you on the idea of 25, 50, 100 R multiple trades. That's ridiculous. I don't trade that way because it's not important to trade that way. It's not necessary. Now we're seeing an expansion on the euro dollar. And now I'm looking at, if we get a run that is overzealous on dollar, it could attack that sell side liquidity pool, but it's not likely. But if it does, that's where the attention would be for dollar, because we've already traded down to the volume imbalance again for a second time. And I'm essentially saying that I have a free look at that euro dollar going to 25 pips. If it stops me out, I lost nothing. I've already paid myself something, not much, but I paid myself something. So this is what you want to do as you practice. If you do get to the point where you've gone through observing and then paper trading, now you're doing demo, this is what you start with. You don't go in trying to catch one shot, one kill. So I'm going to take half the position off here due to time. Okay, the time of the day is 10:37, so I'm taking half off, or equivalent of $5 per pip. So the 100,000 leverage I had on balance now is only 50,000, which is equivalent to $5 per pip. So now I've paid myself, the trade has been funded, and I've taken two partials, or the equivalent of 75,000 leverage. And you have to do this. You have to do these things where if the market's in a liquidity pool or it trades into the liquidity pool and it gives you the opportunity to pay yourself, take something off. In the beginning, it won't feel natural. It'll feel like I should hold on to it, or maybe you didn't hold this long, you get scared. By doing it and by practicing it, it forms a routine and a habit. And you need to have this in your mind when you're looking at the setups. When you have an area where you know you've predetermined a place that you're going to take partials and exit at, you need to execute there when it goes there. Notice what's happening in the dollar index. Okay, we're trading just below that volume imbalance right now, and it should explode with a large range here. But watch, it doesn't do it. I just turned on the execution so you can see where my entries are and my exits on the euro dollar chart. So there is no expansion here. It should do it right now in dollar, but it doesn't. It starts to trade higher. So my concern is I'm late in the New York session. I'm in the heart of the London close kill zone. So I'm seeing it start to retrace now. If it starts to rally again, in my mind, I want to trail my stop loss up just below that old high that I was targeting on euro dollar where the buy side liquidity pool is. I'm giving it a chance because it could be just a retracement to see if it can catapult itself to a higher high. Not higher high on the day, but the higher high in that short-term high it's formed on euro dollar, where I've taken partials at basically. But if it stops me, I'm okay with it. And that's what you need to have also when you're watching and you're observing. Don't have any emotional response to if it stops you out. You're learning. You're watching what price is doing. You're not trying to be right all the time. You're learning how price moves. and how it creates these candles. Notice how it went down, looks real scary, like I'm going to get stopped out, and then it starts to run higher. So now what I'm watching is, does it go above that little red arrow that's pointing down at the highest little swing high? I want to see if it can go above that. If it does, then I'm going to jam the stop loss up above that little trend line that shows the old buy side liquidity pool. But it doesn't do that. So I go in and raise the stop up just underneath the bodies of the candles of the most recent euro dollar retracement. Okay, so now we didn't get above the high, but now I jam the stop up a little bit more, and I'm looking at it thinking to myself, it's not 10 pips. If you see the little blue area on the euro dollar, that's my entry price, and I'm underneath 10 pips. So that's right now at the time of the recording. I'm zapping out right now. You have no idea. My obsessive compulsive disorder is firing on all it's firing on all cylinders. But ultimately, I let it go, and you'll see it eventually trades down and takes the stop loss out. And that is one laboratory experiment that you get to mimic going forward, practicing. But you don't, as a month one trader, use a demo account or paper trading application in TradingView. Don't do this, because you're going to get fixated on watching the money. Like, I have not looked at that money tab next to my entry at all during the trade. I don't care about that. I don't care about the stop loss. I'm monitoring where the eyeball is on the chart. Are we moving towards that? That's trade management. That's what you're supposed to be focusing on. And you'll see it trades down and takes a stop. And that will be it for this exercise. And I hope you found this insightful and useful in your learning. And this won't be the only one you see, obviously. Till next time, good luck and good trading.